Hi friends, I am Mani. I am the blogger behind getmoneyrich.com. Today in this video we were going to discuss a topic called investment basics. And because it is the topic of investment basics, our main focus will be beginners. How a beginner can go about learning investment and what process they should follow to learn the investments so that they build a strong foundation, a strong understanding about investment. So what they should do, how they should go about uh, knowing about investment. So this is the process that we can follow to know about investment. So what is that process? The start of the process is always, it starts with reading about how to invest money. It is in general reading about investment itself. So for me, for a beginner, the process must always start with reading. And while we are reading the investment, what we are doing, we are actually developing the investment basics. This is what is our goal, and it can be achieved by reading good contents related to investment. So what happens after we read? We frame our own investment rules. So once we gain knowledge about something, we start framing our own investment rules. This is very important. Reading, grasping our knowledge of investment basics, and then starting to frame our own rules. And based on those investment rules, our own rules, we are not following anybody. We are reading, we are building our own knowledge bank, and then we are framing our own investment rules. And based on those investment rules, we start to take investment decisions. In the early days, when our knowledge base is slightly small, we will take a type of investment decisions. Later on, when our knowledge base will be more, we will take a more precise investment decisions. So idea is to start reading, build our rules, and start taking the investment decisions. And once we start to take the investment decisions, what will happen? We are going to see the results. Means, suppose we have bought a stock is not good, it will not give a good result. On the contrary, suppose we learned about something and we took investment decisions, and bumper, that stock or that mutual fund went so high that it gave us the desired result. So these are two types of possibilities. Either we will not make a good decision or we will make a good decision. So idea is not that to focus always on good decisions. The idea is to frame our rules, take a decision, whether good or bad, and then learn from it. And this learning is what builds an experience. And for a beginner, the target should be this. Not only you should read about investment, but the bigger picture should be to build an experience. And once the experience is built, repeat the process. And this is what happens. We are building the experience, we continue reading, and we follow this whole process again and again. Over time, because we are also reading and we are also building the experience by taking investment decisions, the knowledge bank will start to grow, and it will become so rich that once a beginner will start acting as a pro in the field of investment. So for me, the best process that a beginner can follow for investment is what you see in your screen. So what next? The next basic that a beginner must know is what is investment. Okay, while we are learning about investment, while we are reading about investment, this is something that we will also know. But In order to gain more clarity, I have figured out a flow chart, and I think it will give you a lot of clarity about what is investment. So see, the process starts from here. This is our money, and suppose we are distributing our money, 65% goes into spending and 35% of our income goes into savings, which eventually we use to buy assets. So step number one, when we earn money, we segregate it into two parts, into spendings and savings. And savings, suppose that saving we are investing and we are buying some assets. Those assets in turn generate returns. There can be two types of returns from the asset. One is it can generate a steady flow of income. Suppose you buy a dividend paying stock. The dividend paying stock will generate a flow of income in the form of dividends. If we buy, say, a bank deposit can also pay regular interest income. Either it can be monthly or it can be annually. So buying an asset will generate returns, and the returns can be in the form of income and also in the form of capital appreciation. What is capital appreciation? Buy a mutual fund, hold it for some time, and its value appreciates. And if the value appreciates, that is what is called the capital appreciation. So, and how to benefit from that capital appreciation? The capital appreciation benefit can be taken when we book the profits. What is book the profits? Book the profits means sell our shares or sell our mutual fund units. So this orange dotted line that you see here, this process, this whole all these steps is what is investment. Buying of an asset, generating returns in the form of income or capital appreciation, and then booking the profit. And what this investment actually does for us, it adds to our existing flow of income. If we are in job, our flow of income is salary, but this orange line, you can see this process also is generating an income for us. So what is investment? Investment is a process of buying assets which in turn will generate returns in the form of income or capital appreciation, and eventually the whole process of investment adds to our bucket of income. So this is what is investment all about. Now, whenever a beginner starts to invest money, this is something that always comes to mind. How much return I will make? Whether it is how much return is small, how much return is good enough. So this is something that we try to read on internet, we try to read on books, but a very specific answer, it's hard to find a specific answer for this question, that what are high returns? How to build this concept? How to know that how much return is a good return? So for that, I will suggest you that we can read about four important things. First is check the average inflation that is prevailing in the country. Suppose the average inflation is 7.3%, let's suppose. So this is one value that we can keep in our mind. Average inflation 7.3%. Do nothing, just go ahead, read about inflation and just check that what is the inflation, average inflation in India for last 5 years or 10 years. Keep this value in mind. This will help us to build the concept about how much return is a good return. So start with inflation. Second is check the index growth. What is index growth? Index growth is like our Sensex or Nifty. check how much returns Nifty or Sensex has given to an investor in a time period of say last 5 years or last 10 years. Suppose the index gave the return of 13.86%. Just remember this value. First of all, there is an inflation which gave a number of 7.3% per annum, and now the index growing at a rate of 13.86% per annum. Don't make a decision yet, just remember these numbers. Then the next thing that you can do is to check the government bond yield, the long-term government bond yield. The government do issue bonds, and so our target is to know what is the yield of the bond that government issues for long term. A 10-year government bond yield in India presently in 2020 this value is much lower, but when I wrote this article at that time it was 7.39%. so just remember, just for the concept's sake, just remember this value. The yield of government bond in India is 7.39%. so what we are beginning to comprehend now, I will tell you. First of all, the average inflation in India is 7.35% per annum in last 10 years. So our objective is, when we invest our money, we should at least make a return which is higher than 7.3%. This is the first concept. Second is, what is the best return that a beginner can get from investment? So this is what is established by checking the return of the index. If we invest in equity, if we invest in an index like Nifty or Sensex, that is going to give us return in the tune of 13.86%. Is it higher than inflation? For sure. Inflation was 7.3 and the return is 13.86%. So two things: inflation, we have to beat the inflation, and what is the thing that beats inflation? Index. And why I'm talking only about index? We can invest in mutual fund, we can invest indirectly in stocks, but for a beginner, what I suggest is a beginner should start with index investing, and once the experience grows, then he could diversify more into more aggressive investments like equity, multi-cap funds, or direct stocks. Now suppose there is to understand the concept that how much return is a low return. So what we have understood here, when we are investing in index, it gives a 13.86. This is the upper end of the return for a beginner. Pros can make even higher returns. To understand the lower end, we can do two things. First is we have to check the saving deposit rates. In India, average interest offered on our saving deposits is around 3 to 4%. So this is the rock bottom. The maximum return our investment can fetch us is the minimum return that our investment can fetch us is 3 to 4%. Secondly, if we invest slightly more aggressively but in a risk-free way, our investment can fetch a return of 7.39% if we invest in a government bond, a long-term government bond. So see the numbers: 7.3%, 13.86%, 7.39%, and 3 to 4%. So these are the numbers. Our returns, our long-term returns will basically vary in between these two values, 3% to 14%. This is the number that we should keep in our mind when we are thinking about investment returns. And again, I am telling you, this is especially true for beginners. Beginners should not expect more than 13-14% returns from investment. Now once we have established our concept of investment returns, we should also understand that why it is important to invest money. So this can be very easily understood from this infographic that you see in your screen. There is a person who earns income, and that person has some current needs and some future needs. Now these future needs can be sometimes very capital intensive. Suppose you are somebody who has just started a job, and let's say after 10 years you want to buy your own house. Example, buying a house, and if you are living let's say in a metro or in a tier 1 city, then that cost of buying a house can be very big. So buying a house is a type of future need, and it is very capital intensive. Only your salary, only your income may not be sufficient to buy the house. So for that we have to save some money, invest the money, and then use the investment money to buy the home in future. So the income getting divided into spendings and savings, the spendings are used to meet the current needs, and the savings upon investment will take care of the future needs of a person. So why we invest money? We basically invest money to take care of our future needs, and this future needs can be very diverse. For a person like me, one of the future needs is also financial, to become financially independent. So you can just jot down all your future needs. Try to imagine that after 10 years, 15 years, 20 years from now, what can be your future needs. So list down all those needs and start saving and investing money for those future needs. Investment is for that. Investment is not to take care of our current needs. Our income, our salary will take care of the current needs, but for future needs we have to follow the investment route. Next, what we should understand is, when we are talking about investment, when we are talking about the need of investment, we should remember that even small contributions is enough to take care of our future needs. Investment need not always be done in lump sum. Investment is not something which is a very capital intensive activity. Even if you are saving 500 rupees in a month, you can put that money, you can invest that money and start the cycle of investment. So the thing to remember is, even small contributions are more than enough to start the journey of investment. If you want to understand how to go about small contributions, you can read about systematic investment plans in this link provided in my article. The second concept that must be understood about investment is the power of compounding. What is power of compounding? In this table, what you can see is $1 invested at 5% per annum, after 30 years it becomes $4.32. $1 becoming $4 after 30 years. Now suppose here I am talking about the investment return of 5%. Now let's talk about investment return of 20% per annum. So $1 invested in year 0, after 30 years that dollar becomes $237. $1 becoming $237 means the appreciation in 30 years is 237 times. Just to visualize this growth graphically, our investment started with $1 and see how it grows. So what we can understand from this graph, in the initial years, for the first 15 years, you can see the growth was almost kind of a slow and a muted growth. But after 15th year, you can see how the value starts to appreciate. There is a steep uptrend that you can see after the 15th year. So what is the concept? The concept is, in the investment there is something called power of compounding, and that power of compounding gives the multiplication power to our investment. But to take advantage of the multiplication power, we have to stay invested for a very long time. Buy something like a equity which can give you a 10-15% return and hold on to that equity for a very long time. And why you want to hold? Because you want to take advantage of the power of compounding. And what is power of compounding? See, in the initial 15 years, the money grew only from $1 to $15. But in the next 15 years, you can see the money grew from $15 to $237. So the longer you stay invested, the more is the chance that you get the power of compounding. Now, the question comes that after we have done all this exercise, as a beginner, where we can invest our money. So there are few options for beginners where they can really go ahead and invest their money. The options can be direct stocks. They can invest in direct stocks, but with a lot of care, because maybe the beginners should start with, as I said earlier, in index, from index investing or through index ETFs. For a beginner, debt funds is also a very good idea. They can start investing in SIPs, in debt mutual funds. REITs is also one of the good alternatives of investment. REITs is basically a real estate linked mutual fund where the money invested by the pool of investors does not go into equity or debt, but it goes into the real estate sector. So if you want to know more about REIT, you can check this link. It is an interesting investment option for a beginner. If one has the capacity, they can also invest in the physical real estate property, a commercial or a residential property. And finally, it is always a good idea to keep some money parked in gold. There is an interesting article written by me about gold investment. Please go ahead and read it. So here are the options where a beginner can think about investment when they are starting. So my suggestion is to segregate your investments into mutual funds and if possible in debt funds. Start with these two and then evolve as your experience grows. Now, when you are starting to invest money, it is very important to remember the concept of investment diversification. What is investment diversification? Investment diversification is not putting all our investment in only one type of asset. So how many type of asset is possible? It can be gold, it can be equity, it can be debt funds, and it can be REITs. REITs means real estate. So what a investor, a beginner, should always try to achieve is they must always split their investments into these asset types. Why I've mentioned only these asset types? There are others available, but for a beginner it is comparatively easy to invest in these alternatives. Investing in gold, you can buy a gold ETF, you can invest in a gold mutual fund. Equity also, you can start a SIP and invest in a equity based mutual fund. Debt funds are also available. Bank deposits, fixed deposits are available in banks, easily one can invest. Even REITs has come. REITs is like a shares of they are traded in the market like shares are traded. So one can buy REIT shares like they buy normal shares. So these are few investment options that a beginner can explore. And why they will explore so many investment options? Because it is important for investor to always keep your investment diversified. One should not invest all their money in one area. It is always to spread the investment. And then I will like to talk about mental blocks. Why mental blocks? Because when we start the investment journey, what we are doing is we are not spending that money, we are saving it and then we are spending. So because we are cutting into our spendings, we want, as a human being, we all want to spend more and more money. But here we have to restrict ourselves, we have to restrict our spending urge, and we have to save some money and then invest it. So at that time I personally have experienced that our mind starts to play tricks on us, and this is where our mental blocks are created. And sometimes you will hear yourself saying that I cannot invest because I can't afford it, my income is too low, I'm earning only this much, my income is not big enough that I should go about investment. These are some things that will come into your mind, these thoughts. So you should cut that thought. Even if your income is very small, still I believe that for a normal working class individual, educated individual, investing 500 rupees a month is possible, right? So if really you are in a problem, your income is not so much, your savings is not so much, still go ahead and invest at least 500 rupees. Start the journey of investment, even if it is from 500 rupees a month. The next kind of thought that will come in mind is, I will start investing from tomorrow. I will not do it today, I will do it from tomorrow. Don't listen to your mind. Go ahead and start from today. These days we have very good investment related apps. Open your account in that app and you can start the investment upon click of a button. Don't wait for tomorrow. Go ahead and start investing from today. If your mind is saying I will do it from tomorrow, it is only a mental block. Start from today. Sometimes mind will also say that equity shares, equity mutual fund, they are too risky, why to invest in them? It's true, they are risky. Your mind is not lying, it is risky. But remember, you are not investing for a short period of time. Remember, you want to take power of compounding. So how to take the advantage of the power of compounding? By staying invested for a very long period. So if one is staying invested for a long period, this risk of equity becomes almost negligible. It is very unlikely that if one stays invested for such a long time, they will make a loss in equity. It virtually not going to happen. So this is only a mental block. If somebody tells you, if your mind tells you that equity is risky, let's not invest in it, remind yourself that you are not entering into the world of investment for short term returns. You are going to stay here and stay invested for a very long time, and you are not going to make loss if the investment horizon is so big. So I hope you like this video. Please give me a thumbs up if you like my video, and please do subscribe to my YouTube channel, and press the bell icon so that whenever I place a new video, you will get a notification.